I feel like the best way to show you guys the equity method is to look at a numeric example. Alright, so looking at this, January 1st, 2013, Wilmering purchased 25% of the common stock of Apex Inc. for $180,000. 25% clearly puts us in that equity method area unless we have some way or reason to get out of it. Alright, at the date of the acquisition, the book value of the net assets of Apex was $400,000 and the fair value of those assets is $600,000. During 2013, Apex, let's stop there before we even start talking about the dividends and the earnings of $100,000. The fair value of the assets is $600,000. Our percentage of ownership is 25%. That is our share of the fair value of the assets of the company is $150,000, but we paid $180,000 for them, right? So the first step really here is figuring out from the fair value of the assets of the company and a percentage of ownership, what is our share of the fair value of those assets. If we paid more than it, then we paid an extra $30,000. All right, we paid an excess over the fair value of the assets. That extra $30,000 is going to be referred to as goodwill, which I can't remember if you guys have covered goodwill yet, but goodwill is basically the amount you pay beyond the fair value of the assets being purchased. I would like to look at another example with you guys, one that has a little bit more meat to it. Alright, so on January 1st, 2009, Matrix and Apex again, but not following from the previous example, new example. Matrix Inc. acquired 45% of the equity securities of Apex Inc. for $1,350,000. On the acquisition date, Apex's net assets had a fair value of $3 million. During 2009, there were dividends of $150,000 and net income of $1,750,000. The question is what amount will Matrix Inc. report on the balance sheet as an investment in Apex Inc.? All right, so originally it was $3 million was the fair value of the assets, 45% was the percentage of ownership, and that is what we bought. All right, so in this case, we don't have any goodwill that we're dealing with here. And the fair value of the assets purchased is $1,350,000, and that's how much we paid. So originally our journal entry at the beginning of the year is a debit to the investment in Apex Inc. and a credit to cash for $1,350,000. Okay, now remember the equity method means that we have a significant influence. We're tied to this company to some degree. So when the company shows net income, we need to show net income as well. Well, not exactly net income, but we need to show the increase in the value of the asset. And when a company pays out dividends, we need to show a similar decrease in the value of our asset. All right, so let's look at this with numbers. Oh, let me go back a second, 2 up. All right, so here we are. So back to this slide. We had the company paid out dividends of $150,000, and it had net income of $1,750,000. So looking at this, the dividends that we paid out, that actually reduces the value of your company if you think about it, because it's cash you're paying out, right? So there are $150,000 in dividends paid by the company that we're investing with in Apex. We have a 45% ownership, so our piece of that dividends is $67,500. That actually decreases our value in Apex. So even though that $67,500 is actually cash coming into us, it decreases the value of the investment in that company because the value of that company has gone down by that amount as well, right? So we get cash because the dividends are coming to us, but it reduces the value of the asset of the investment. So it was worth $1,350,000, and we're going to reduce it by the dividends that Apex paid out. All right, now on the flip side, Apex also made money this year. They had $1,750,000 in earnings this year. Our 45% ownership of that is $787,500. So basically we're saying that since that company is basically 45% ours, we're increasing our investment in Apex by $787,500, right? Originally it was $1,300,000. Then we reduced it by the dividends, and then we increased it by a proportionate share of the earnings that the company made this year. And we are actually going to record revenue, even though it's not technically Matrix's revenue, it's technically Apex's revenue. We are going to record that revenue that they made, $787,500, as revenue on our income statements. So from a T account perspective, this is what our investment in Apex looked like. Our original investment, the reduction by dividends, the increase by earnings. So our investment in Apex at this point is $2,070,000. Okay, so, this is our example with the $30,000. All right, moving on. We're going through this. All right, it's another example showing what happens when you have that 30,000, that excess with the goodwill piece of it. All right, so now what happens if you want to change from one method to another because your level of influence changes over time? You might have to change from the equity method to another method. So the idea is at the date of transfer, when you decide your level of influence has changed, the carrying value of the investment under the equity method is regarded as its cost. All right, so I guess I'll let you guys read through these remaining slides. They are covered in your book, but the idea is that you just need to account for things like any different, as it says here, if you're going from the equity method to another method, the difference between what the value that you're carrying the asset for on your books, the investment, and the fair value is going to be recorded in a valuation account and is going to be recognized as an unrealized holding gain or loss. All right. I hate reading slides to you guys, so I'm going to let you read through these on your own. It's just I'm not asking you to do any calculations here. Really, it's just understanding the difference between the different scenarios if you change from one method to another. If you change from another method to the equity method or from the equity method to another. I think that covers the major calculations in this chapter, which is really what I'm trying to get through to you all. Since you don't have the classroom experience, I want you to be able to have somewhat of that through these screencasts. I hope this worked out for you, and I hope you found this helpful. And I will be starting on the next chapter very shortly. Have a great night.